And everyone, welcome to another edition of Your Money Radio. Danny Stewart, Don Vanderboard, Hunter Mazinga with you. I'm Tim Razor. Lots and lots to talk about as the market pulls back. I want to go over that. I want to go over the VIX inversion that's taken shape today on Friday. What is this Friday? The 15th, Danny. The Friday the 15th. So it's options expiration. Yeah, so you've got some options expiration shenanigans going on today. Talk about maybe the potential for a deeper pullback, which I think exists exponentially at this point, and I'll explain why. Want to talk about supply issues, which are huge. Talk about savings issues, which affect the market. But I've got bigger issues to talk about real quick. Danny, I don't know if you saw it. Jesus, Danny, don't you give a warning when you turn that Colonel Sanders beard towards us. It's like a flash of light.
You love it, Tim.
It's finger licking good.
Wow. Okay, so that helped. Can you do that again? That literally threw me off.
It's finger licking good.
Now, Danny, move your mouth to "it's finger licking good" when Don does that.
Come on,
you think you can time it up?
1, 2, 3. It's finger licking good. Dan, you're supposed to move your mouth. Did you not hear the instructions?
Oh, I see.
You see. Okay.
Now you see it. Okay, can you try it one more time?
On that. Let's try it
3,
again.
2, 1. It's finger licking good.
A little delay.
That's like the Iron Chef when they used to dub it. So that's back in the early 2000s. All right. So listen, stockholders market, a lot to discuss. But before we do that, Danny, I've got two things that are huge in my life. One of them involves the Eagles. We let go of our coach, Danny.
I saw that.
What the hell? And so we got to discuss that.
You got some high school coach, didn't you, or is he college?
No, Cowboys do that, Danny. Cowboys do that. But I've got big
five Super Bowls. 5 Super Bowls. How many do the Eagles have?
One. Uno, Danny. Uno. We don't want to crowd the display shelf. We want everyone to focus on that one.
That's the argument.
Yes. Look, Danny, I've got big soap news. So I've got two youngins, and I've got the Remster is he's a Mr. Bubble man, Remy. Danny. Remy is a Mr. Bubble, and I'm trying to teach him, how to wash yourself. But I thought of you because I know you, Danny. I don't reckon you use shampoo. Like, you just take a bar of soap, right? It's just ivory all over, right? There's no shampoo in your world.
Yeah, look at this head of hair, man. I use conditioner and shampoo.
Oh, well, based on that, looking at that hair, I just figured you were an ivory kind of fella. What about Lifebuoy?
I thought lava.
Oh my God, lava with a pumice. So,
but hang on. But if I don't have any shampoo and conditioner, I've been known to use a bar of soap. Or if I'm trying to travel light, I'll just take a bar of soap, especially if you're going camping. You don't want to be weighted down.
Well, look what I found for the Remster. And I picked one up for myself here, Danny. The Mr. Bubble all-in-one cleansing bar. And let me tell you something, folks. This thing is amazing. I'm not making that. That thing is amazing. I've been showering with that for 3 days now.
So who'd you really get it for?
Yeah, well, I don't want to lie. I got Remy. I got Remy.
The Remy likes. Man, Tim's the one playing with those Tonka trucks.
Yeah, if you look at the first line of the description there, and it clearly says, "Put the power of clean right into the palm of your kids' hands."
Yeah, but they want you to test it. So I've been tested. I got a couple of these, and I tested it, and then I got Remy. I don't know where they have it. Not the bath potion, but they absolutely have what they call bath crack, and it's like you can pour it in. Oh, right, Hunter's like crack, and so
crack will pique my interest. So
there you go. So bath crack is like Pop Rocks, like that you would eat, except for the bathtub. Fantastic. And then, Danny, get this. They've got Mr. Bubble cologne.
Of course they do.
And have you purchased any of that? I could see
I didn't.
you being a Mr. Bubble cologne guy.
Oh my gosh, I'm going to get it though. And the next time Tanya and I venture out for a date, I'm absolutely wearing it. So yeah, I absolutely do that. But Hunter, I want to talk some stocks here with you real quick before we talk Selloff and stuff. So Hunter is huge into the online gaming, and by huge, I don't mean he has a gambling problem, but he follows these things really closely. And I haven't purposely looked today to see what the DraftKings is doing. This is a weekly chart, or to see what Penn Gaming is doing. But I want Hunter to talk about these stocks because I think this is, look at this run. I think this is the market, right? Because when you get there's going to be stimulus put into the economy, and the money supply is going to continue to grow. And this is the new 1999 paradigm where you have people putting money into the stock market. I mean, it's clear that's what happened at the end of stimulus, when stimulus was first introduced last spring, early summer. But the exponential growth of a Penn, which by the way is tied to not only the Barstool app, but they do have casinos, and then DraftKings, which is a myriad of different offerings. I wanted to talk about these, and then I want to talk about where might possibly be the best entry, and I'll explain that in a second. But go ahead, Hunter. Tell me the differences with DraftKings Penns and what you like about DraftKings so much.
DraftKings is strictly online. There is no physical casinos or anything like that. And maybe the biggest difference is the lack of physical locations and the fact Penn has Barstool and they got Portnoy. And the Portnoy effect is real because you can see what Penn has done since, that acquisition.
Mm-hmm.
But they're different things. Penn offers no daily fantasy gambling. That's DraftKings, and there's another company called FanDuel. Those are kind of the big leaders in that group.
Mm-hmm.
Penn has a sports book, which so does DraftKings. But from what I understand, Penn's sports book is only available in one state, which I believe is New Jersey. And I mentioned to you right before we actually started the show, New Jersey reported record sports gambling in December, just shy of $1 billion wagered on sports bets in December, and I think about $6 billion for the year. So, part of that's probably football wrapping up, basketball starting back. You got a lot of sports in December, but that's the difference between the two. And really, over the last month or so, or maybe even a little shorter than that, the last couple of weeks, Penn and DraftKings kind of go back and forth. One day Penn will be up 5% and DraftKings will be flat. The next day, the opposite will happen. But I mean, when you look at the charts, Penn has been the leader, for the majority of this year, especially since like August, September range.
And so when Hunter started to tell me that news about New Jersey, and I normally follow a fellow on Twitter, Dan Ravel. That's where I get all that news from on Twitter. And I hadn't looked today on purpose because I wanted to talk to you about these stocks. I think that information is kind of known, and that's what you've been seeing in December, January with these stocks. But when you look at, say, the Russell here, I want to put the Russell up because the Russell's just gone on this amazing run, and we're going to put it on a weekly chart. This isn't normal. I mean, this is just this is a weekly chart of the Russell's move, 1525-ish from the mean down here, 1543, all the way up here to 2122, 2164 at the high. And so what Hunter's in, I think these stocks are actually, they're going to be, if there's going to be a swing in 20s, I think those are the types of stocks that lead because, eventually older people who don't participate with a Penn gaming app or a DraftKings gaming app, they're going to die. And I don't mean to be morbid about it, but yeah, Danny, shocker, old people are going to die. And that what's left to inherit the earth are the younger people that are embracing this type of technology and this aspect of gambling, which by the way, makes me wonder if Las Vegas is going to change. Do people need to go to Vegas in the future? That's another thought for another.
I did see a couple of days ago, I can't remember, I think it's Las Vegas Sands, I could be wrong, but they said they were going to make a push to digital sports gambling maybe a week ago or so.
It's kind of like they have to, right? What's the if you don't have to go into the sports book anymore, why have that physical building? And so, but when you look at the Russell here and this run, it's not that it's unprecedented. It's just that it's not sustainable without pullbacks. In the history of time, there's always always going to be a moment to pull back. And I wonder if that's where we're at right now. And look, you just consolidated here. If we take it down to a daily chart, all you did was consolidate I mean, this is just epic. You did a sharp correction back here to start the year, and now right back up to that third rail, but you did pull back to the mean. And those that are following the work know the value of the 21 exponential moving average, which is in fact the mean. But Danny, when I look here, say at the volatility futures, that sharp pullback in January was absolutely accompanied by what I'm about to show stock nerds. It's the VIX inversion. And so this contract right here, if you'll forgive me a second, this contract right here, the 2390, trading at 2396, this January contract only has 5 days left on it. This February contract, which we're going to roll to next week, is trading at 2560, and the March contract, which is active, is trading at 2623. Oh, they're not inverted. They literally, why that on inversion changed, so they're not inverted. You know what? We do the show live and we do the show transparently, so they are not inverted anymore. When I came on, or when I was looking at this first, what's that?
Pretty flat though. That's still.
Oh, well, yeah, well, they were inverted, and it doesn't really change my analysis here. If they invert this February contract to this March contract, that pullback that you saw here from 2011, say all the way down here to 1940, you're going to see that type of a pullback, I believe, in stocks. And it would make sense to pause here. You just got earnings. You got earnings season kicking off this coming week. I think Netflix has got a lot to say about how tech behaves next week when they report on Tuesday. And then that kicks off the big tech earnings that'll follow in the subsequent 7 to 10 days from Netflix's report. So when you look at, say, let's look at the S&Ps here. So the Russell has been clearly the leader. The S&Ps, what did they get up to? They got up to that 2 ATR, and they've come back down to the mean. Now, where they closed today, I don't know, or how they closed today, I don't know. But when you think about what has happened in the last, I would say since the start of the year, Danny, and so this year alone, in 2021, Danny, we talked about this in the morning call, 44 special purpose acquisition corporations have gone public, or SPACs, as you might know them. That's 20%. That's 20% of everything that went public back in 2020. That's huge supply. There's only so many dollars right now that can go into stocks. Right? When you have that much supply coming on, add in the massive Affirm, Wolf, which is Petco, and Poshmark that came public this week. That's a lot of money that needs to go into stocks, and so, or that is kind of being spread thin. And so, if you see stocks like Amazon here, you see stocks like Amazon, how have they been behaving? Well, Thinkorswim is not agreeing with me today, but if you can see this, I don't know if you can see it through the haze. They've been laggards. Don, what didn't you send a stat over this week about Amazon's performance relative to the rest of the market? And I'm putting you on the spot there. I believe you did, and if you didn't, I apologize.
All of the FANG stocks are massively outperforming, especially over the prior 3 months. They're all of their relative strength is below 25.
Mm-hmm. And so,
which means 75% of stocks in the market are outperforming those big cap stocks.
Underperforming, not
they're underperforming. Totally. Yeah.
So if you're looking for Apple to lead, and Apple does look better than Amazon or Facebook to lead, or Google to lead, or bigcaptech.com to lead, you're not seeing it, and it has to do with all those SPACs that have come public. I mean, it's a huge amount of money that's been raised in SPACs, and it's coming from somewhere. And you might say, well, Tim, I heard there's $5 trillion still on the sidelines. There is $5 trillion still on the sidelines of the market, but at the same time, the savings rate in this country has never been higher. Two things that happened in this recession, this economic recession. It's not a recession in terms of the stock market by any means, but the economic recession that's taken place in the economy. You've never had the living wage rate go higher. people's wealth rate went up since the pandemic started, and has to do with the stimulus, which Danny, I think, could talk about that. Danny is the one who could talk years about that. In the mistake that was made in 07, 08 was they gave the money to the corporations. They didn't give the money to the people. That right? I mean that.
Yeah, well, yes,
Yeah.
absolutely.
Yeah, and so in this recession, they gave the money to the people, and look what you had happen. You've had an explosion in the gaming stocks. You've had an explosion in, and I'm not going to go off on a tangent about sports cards, but there are records being set every day in the value of what a Mickey Mantle card just sold for $5 million last night. Like you're having this this explosion in asset prices, whether it's a sports card, whether it's used car prices have never been higher. Used cars, Danny, for the first time are actually appreciating. That's how in demand they are from services like Carvana, CVNA. And if you look at a stock like CVNA, and this is why when we say you separate Main Street from Wall Street, which sounds just cliche, but you know, when you see a jobs number that says 140,000 jobs lost last week, you know, for the December jobs report, but then you see a stock like Carvana up, look, Carvana's stock is going up and the automakers' stocks are going higher because people out there buying, they're spending. And it's because the money's been given to the people through stimulus. And they're about to get another big dose of it. So while I think the markets are going to pull back here, I think this is the, if it's going to happen, I think it happens within the next 2 weeks. When I put this on a chart that you're used to looking at with a 21-day, an 8-day, a 50-day on here as soon as it populates, that the chance to come down to the 50-day here does exist. Now you bounced where you're supposed to bounce, so that's not bearish at all. That's bullish. You come down, cleanse the palette at the 21, just like you did here. But what makes stocks go higher? You're now in earnings season, so that's the question. What makes stocks go higher from here? But what if it's already baked in? Think about what's happened with stimulus. If I just told you that stimulus is what I believe, and it doesn't have to be true, that stimulus is what's driven DraftKings, Penn is what's driven the Carvanas of the world higher. When Biden announces his stimulus plan last night, why doesn't the market just explode today? And it's really easy to say, well, that's Tim because it was baked in. But there's also a burden that you have to examine in that, one, can the plan get through? You can't get it through. The plan, the way it's written right now, the bill, the way it would be written, can't be done through budget reconciliation. It has to actually get a vote of 61 senators, which may be tough. I don't know. I don't want to get into the politics of it, but there's also that $15 provision for whatever is going to end up being defined as frontline workers. That, again, not engaging in the politics of the situation. $15 is wonderful, but the businesses you're trying to help, not the Amazons, not the big Walgreens or CVS, but the small mom and pop businesses that I don't know what the definition of frontline worker is if the store is open and not shut down. That $15 an hour is going to hurt that business. And you could say, well, that, you know, that makes the bill a little bit tougher to get through. And so and maybe you're seeing that kind of reflected here, that they're going to jostle around a little bit and it's going to delay that stimulus. Just like, remember, Don, at the end of December when all that stimulus was delayed and then the market started just shaking out of a bunch of stocks, of leading stocks. They just started coming off the board. And so, which somebody at home surely is going to say, well, Tim, once this stimulus stops, what's going to happen to the market? It's a good question to ask. Tim, what happens if there's more supply brought into the market where it's a rush to get your IPO out? It's a rush to get your SPAC to come public. And what if there's not enough dollars to go around? If I ever explained to stock nerds why stocks come down? So Amazon here is down just 0.6% today, just under $20 at the moment I'm talking to you. And so it's real easy to say, well, there's not enough buyers and there's more sellers, but that's only half the story. So to get a stock price to go down, I mean, maybe some news could come out, maybe a downgrade, which would qualify as news. But a lot of people forget that the stock market is a genuine auction. So if Danny's the auctioneer, he has Amazon, it went up to 3140 this morning, Danny. It was trading 3140. And Danny, someone bid it up to 3140, and Danny raises his hand to the auctioneer and says 3140, and all the hands don't, they just sit on. And Danny goes, okay, 3135, and nobody raises their hand. Danny had to take price all the way down. The low today, I believe, and I'll show this to you right now. The low today so far was 30.95. The auctioneer had to get the price to 30.95 to find where the buyers were. And so it doesn't have to be some nefarious news story that gets money to that gets your stock to go down. It can just be simply that lack of buyers interested at the price it's being auctioned off at. And so understanding that well, where are the buyers? Give me a stock that's up on a down day today, please.
Palantir, PLTR.
Oh, great talk. Okay, now I want to transition. Don, can you tell me, I want to talk about what you discussed on the call today. Can you explain Palantir, not the company, but potentially what you described as the Cathie Wood effect?
Yeah, Palantir is, we own it in-house in a couple of portfolios. Cathie Wood, who runs the ARK ETFs, bought Palantir for the first time last night, and that just popped at 6% after hours yesterday, and it's held in a tape where probably 90% of leading stocks are down today. And that she is probably the most powerful name in finance right now as far as growth stocks go.
More powerful than Buffett.
Without absolutely. For one thing, yeah.
And can you explain Cathie Wood, who she is and what she does and what funds she runs? Or
she the three main ETFs are ARK-K, ARK-G, and ARK-W. I think that there's about 6 or 7 altogether, and she's about to launch a space fund. But they're all about technology and forward-looking growth stocks, and they've become extremely popular with the big move up in those types of stocks over the last 9 months. And they're fully transparent. At the end of the day, they put out an email with all of their buys and sells. If they're selling a stock, I guarantee you're going to see weakness in the stock the next day. And if they're buying one, you get the Palantir effect, which we're seeing this morning.
Younger investors, and I want to be really careful here, because when these people say Robin Hooders, they say it derogatorily, and I don't think it should be done that way. But there's a group of traders that do what Don just described. There's nothing wrong with it, but when they announced they were launching a space ETF, I want you to just look at what happened in the stock, literally space, which is Virgin Galactic, just literally like a rocket ship, back close to old highs, from trading below all the moving averages, trading closer to 20, and now you're above 31. Now it's down a little over 5% today, but that's not a bad candle in a really tough tape. And so you're seeing this effect, and so there's only so much money right now to go around until that money feels comfortable. And by the way, they're not going to send you an invitation of when that's going to be until that money feels comfortable coming off the sidelines, that maybe the pandemic is going to be winding down, and who knows when that's going to be. Then you'll notice that maybe some of the stocks that led in 2020, the Amazons, I mean, that was just a massive run. Amazon went on and it's digesting it. There's nothing wrong with the stock. I mean, and the axiom of buy what you know, look, you can't discount it. And you can tell me that every day Amazon trucks come to your house, but right now the stock, even on a weekly chart, it looks just fine trading at the weekly mean. It's a laggard compared to other stocks in the market. And so you got a lot of forces right now. These last 2 weeks of January, you've got the start of earnings season. How does the market interpret the political news? And by political, I just mean with the stimulus plan coming out of the president-elect's office. What's going to happen And my thought is, if you asked me, if they watered down that $1,400, was that $1,400 not enough? Is that what the market's reaction is today? Is it just simply options expiration? Is it just time for the market to pull back? If you lived in a news vacuum and you looked at that rut chart, you're like, it makes sense, especially on an average true range basis, that the market pulls back. But there's a lot of forces here, I think, that muddle the picture of where stocks go from this point. But I don't think, and I'm going to get Danny, I'm about to come to you, so pay a little closer attention.
I'm awake. I'm here.
I know you are, but I just wanted to give you a heads up. I'm not bearish on stocks. I might be for the next 2 weeks, or I just think they trade sideways. I could be wrong, but I don't feel bearish on equities simply because interest rates, all that money that's on the sidelines, that $5 trillion that's sitting on the sidelines, is doing nothing. It's a safety net right now for folks. So it is doing something in that regard. But in terms of growth and fueling your retirement, it's losing value every day. And so that goes to bonds. And Danny, I'm going to have you talk about the dangerous situation bonds find themselves right now, and why a 60-40 portfolio is dead. Okay, so that's one thing I want you to discuss in just 1 second. And then I want to talk about the money supply. The more and more we print, which that's what stimulus means. Right, wrong, indifferent, that my comment isn't centered around that. We're going to be increasing the supply of dollars into the market, which does what? When you increase supply, what does that do? It drives down price, right? Because there's more of something. That's why Bitcoin was going up, right, Don? How many Bitcoin are there total? 21 million?
Yeah, approximately.
Okay, 21 million. That's why, what does GBTC trade for on a premium basis?
Right now, around in the high teens to 20%.
Very few. How many ETFs, Don, can you think of, and I can't think of any, that traded a premium, which sounds kind of ridiculous like that?
Just the ones that really are tracking these cryptos.
Because there's not enough of it for to meet demand. So price goes up, and you can charge premiums. You can get that premium in that price. But when you print more dollars and you increase the supply of the monetary pool, which is the US dollar, the world's reserve currency, it drives down price. And when you drive down the price of the dollar, that is good for equities, and that is good for our global. Yeah.
Drive down the price of the dollar, not assets. It'll drive.
Right. So, Danny, I want you to talk about the growing, why the growing monetary supply is good. I want you to talk about it's good for stocks. It's good for stocks. Okay. There you go. You can caveat it with it's bad for consumer purchasing power, if you'd like to. I'd like you to talk about the dangerous bond situation. And then I've got something, Don, it just left my head, but as soon as I think of it, I'll interrupt Danny. I'll tell you what I'd like you to discuss here in a moment.
Well, that's good, because I got something to discuss with you too.
Is it anything to do with the value of Carson Wentz cars, which are
indirectly?
Fantastic. All right, go ahead, Danny. I'm sorry.
Well, and by the way, very quickly to your point about the $15 an hour wage with respect to pick and choose what's essential and what's not. Even the companies, the small the small businesses that don't quote have an essential employee and therefore wouldn't have to pay the $15 wage, it's going to put pressure on them because their employees are going to say, wait a minute, I can go work somewhere else and get $15. I don't want to work here anymore. So it's going to put a lot of pressure. That's going to be a tough thing. All right. So you want to talk about bonds and the money supply, because those are related. I mean, they affect one another. So right now, the Fed, because of printing so much money and buying bonds artificially and driving down the interest rates to record lows, the bond coupon rates, the interest rates on bonds, if you're a new buyer, are so low, they don't warrant the risk. That's number one. But number two, bond prices work inversely with interest rates. So if interest rates drop, prices go up. When interest rates go up, prices go down. Now, here's the thing though. They don't go down or up linearly. In other words, equally. So when interest rates first roll over from peaking and start to drop, you're going to see the biggest gains in bonds. They'll happen right away. And a 1% drop in interest rates, you may see a bond portfolio with a particular maturity go up 9, 10, 11, 12%. But after rates have dropped more, one more 1% drop, you may only see a 3% pop. Right now, at these real low rates, historical low rates, a 1% drop from here, which is kind of hard to fathom, but I suppose anything's possible with the Fed, you're only going to see a modest bump up in bond prices. However, or conversely, now that we're near the bottom somewhere, I don't know where it is with what the Fed's doing, but when rates rise 1%, bond prices are going to they're going to go down 9, 10, 11%, depending on their maturity, versus much further or higher up in the end of the rising interest rate cycle, they may only decline 3 or 4, they may decline just a little bit. So I don't want to get too complicated. That's called convexity. So it's not linear, but here's the whole takeaway is that bonds are riskier than I've ever seen them in, well, maybe the late 70s. And remember, between 78 and 79, bond price, treasury bonds lost 32% of their value. They were like tech stocks. Okay, and that was because inflation. Now, interest rates are rising. Interest rates are bad for bonds. Inflation is kryptonite for bonds. It makes it much worse. So the Fed has painted themselves in this Hobson's choice: to print or not to print, or can they slow down, meaning raise interest rates to kill inflation when it does start. So if they get if the economy, the velocity of money starts to turn over a little bit, with all the money supply, the wash in money you were talking about, Tim, will that cause runaway inflation? And if it does, how do they raise rates to stop it? Because if they do, you're going to cause these huge debt that we have. Our interest expense on our debt goes way up. So they're damned if they do and damned if they don't. It's hard for them now. They're in a situation where, you know, it's almost like it's going to be very difficult to turn back. Now, so you were talking about the supply, the money supply. To put it very simply, if you've got $1 trillion in asset, now we're just throwing around trillions like they're billions. It used to be millions, now it's billions, now it's trillions. But say you've got $1 trillion of assets, and you've got $1 trillion of dollars to barter and trade and support those assets. All of a sudden, without any new production, new efficiency, new anything, growth, you print an extra $1 trillion. Well, you didn't get any productivity. So now you got more dollars that are going to bid up the price of those assets. That's what inflation is. Inflation, by definition, is strictly monetary in nature. And so, like a while ago, you were talking about the price of used cars going up. Part of that was because the manufacturers went offline for COVID for about 4 months. And so the new cars dried up. You couldn't find them. So it popped the price of used cars. That's a supply and demand issue, is more so than it is inflation. But it feels the same to the consumer, but to this money printing problem. So if they continue to print money, it's going to cause inflation sooner or later, probably sooner, but you'll see it on the charts. They can't raise rates. They're trying to figure out what they're going to do. And so now they've come up with this new MMT, modern monetary theory. If you hear MMT or modern monetary theory, that's these wishful economists that think that it'll be different this time. This time, it's not going to be the same. Monetary MMT means that you can print as much money as you want and stick it in the system, and well, it just doesn't matter. It's not going to cause that they can control it, that it just doesn't matter. It's really been put forth out there, and it's been around for a couple of years. They're trying to warm the general public up to it so that when they have to start printing massive amounts of money, they're already doing it, but even more, that you've already accustomed to it.
But
that's
isn't the flip side, without these actions, we would probably be in an even worse recession than 2008.
Well, look, here's the problem. Politicians are corrupt on both sides of the aisle. It doesn't matter. So they could have got the same effect with hundreds of billions of dollars, sending it directly to small businesses and families that were in trouble. That's all you need to do. You don't need to pay money to foreign governments. You don't need to pay money to museums. You don't need to do all these special interest things. So we're doing a $2 trillion deal, and really only 800 billion is or so is, I hadn't read this one, is earmarked for the small businesses families. So the bill is over twice as big as it needs to be just to get it passed, so everybody gets their special deal in there.
Sure.
That's the problem. It's that it's not the part that's going to support the problems that COVID created. That's not the problem. The problem is all the excess. So I'm okay supporting,
right,
what needs to be supported, but all the other stuff, it's going to come back.
And I'm going to point out what separates us from a Peter Schiff type. So and look, the show's not rehearsed. Like we don't discuss. So Danny doesn't really know what I'm going to ask him. So you're getting Danny's genuine.
I never know what you're
asking. Yeah. Don doesn't either. And Hunter really. I had to stop Hunter from talking, so he was taking all my talking points for him. Like, Hunter, stop talking to me. Yeah. But that doesn't. This is where we separate ourselves. And if you don't know who Peter Schiff is, just Google Peter Schiff and Bitcoin. Or Google anybody. Don, who's a famous short person of Tesla? I don't know one off the top of my head.
Mark Spiegel.
There you are. Okay, Mark Spiegel. And so, look, there are people that are wed to their ideals. And that's not so bad like in the sports world or your morals. But when you look at a chart of, and Bitcoin's pulling back here today, but when you look at a chart of what's happened with Bitcoin from November, I mean, this is a massive move, right? It's really hard to be bearish about that. So if you were bearish on cryptocurrency and you see two closes above the 21 back in October from 11,000 and it goes up the, whether you want to label it a short squeeze, whatever you want to label it as, hokum, this to continue to be bearish, you're leading sheep to slaughter. And it's evident here in Tesla. So Danny, I get the sense, isn't thrilled with the bill, but it doesn't stop us from participating in markets.
Oh yeah, right.
And I really want to make that distinction because there's a number of stock nerds and market lovers that have not participated in the market because they don't agree with what's happening, or they feel like it's always too late. And what we've been trying, Hunter's going to start doing videos this Monday. Is Hunter, this your first video this Monday?
Tuesday, just because markets
close on Monday. Yeah. And so what we try to illustrate is the process of buying stocks that are high quality by our fundamental standards, which we try to elaborate on in our daily videos, where to buy them at, and when you're wrong. And that mental flexibility, that agility to do that is crucial, not just in this market environment, but any market environment. Because look, there hasn't been I'm bullish on the markets, but when I show you this weekly SPX chart, and it doesn't matter time or year, there hasn't been a time where you don't come up above the purple line is a weekly 21 exponential moving average. There hasn't been a moment in time where you don't come back and correct to the mean. And if you correct below the mean on a weekly chart, as Don likes to say, typically nothing good happens below there, and you want to stand clear of it. But when you get a close above that weekly mean, that's good stuff. Test of the mean, that's typically a buy zone. But there hasn't been a moment in time, no matter what the market is, that you don't come back and test the mean. And it's a rising mean, but it doesn't mean you're not going to come back and test it and test it and test it. And whether this is the start of the price coming back to meet a rising mean, I don't know. But having mental agility, I'm bullish on equities for the reasons that I laid out. Like there's kind of no other choice other than Bitcoin, right, Danny? Like,
right.
Yeah.
Well, one thing I'd like to point out that I didn't quite hit your point you were asking was inflation good for stocks? So when you start getting inflation, mild to moderate inflation actually is bullish for stocks. It's bad for bonds. Bonds will start selling off. So if we start getting inflation through the pipeline, bonds will be more risky than stocks. Now, as inflation rises higher and higher and gets into the high single digit or even double digit, that's probably a ways away. But when that happens, a lot of stock sectors will drop out, and you have to focus on the resources and the sectors that actually are inflation type stocks, and other areas will be horrible too. So very high inflation, there's only going to be commodities and precious metals in certain sectors that are like the money market or bonds during deflation. So you gotta be able to switch and be flexible. And to mild to moderate inflation, stocks are going to be the place to be.
So when the facts change,
60,
so
40.
what Don is fond of saying is when the facts change, we change. So Don, what has changed this week, and what are you interpreting today's price action and this run to start the year? What is your interpretation of this? You can start with anything you want, your interpretation or moves that we've made this week.
Well, let's talk two buys that were done on Monday. We got stopped out on today. That is a feedback mechanism that tells you what you're moving into isn't working, so move on from that. Lulu was added to the 21 over 21 list last Friday. It had a move up off the moving average on Monday. We bought it, and it just flat failed. The last 4 days have been ugly, so we got stopped out today with about a 6% loss on a 4% position. We added to NVIDIA on Monday. Over the weekend, there was a lot of attention to their partnership with NEO, and they tried to break out of a tight pattern that they've been in, and it just promptly failed. And NVIDIA falls into, you can see how long that's been going sideways. That falls in with the Amazons and the other big cap tech stocks that really haven't gone anywhere since they peaked in the fall, and just couldn't get any traction. We had as much as a 70 or 80% gain in it, and the rest of it took off the board today at about a 55% gain. But that doubled what the market did, so we accomplished what we were trying to do, but it's been dead money for the last 3 months plus. So that's the kind of feed, and that's the first time in a long time that we put money into something and it quickly got stopped out within a week. So IPOs are hot, SPACs are hot, oil and banks had a great week until today. Some disappointing reaction to some of the banks' earnings this morning, although that may just be taking some money off the table after a nice run.
Can you pause there for 1 second? I haven't looked at the bank stocks today. I purposely try, stock nerds, to not. I don't do that much research before we go on the air, only because I want to do this live with you. I don't want to have it sound canned. So I'd like to just do the banks in the prism of the average true range, Don. So pretend there were no earnings. Let's just see how they reacted, where they were on their ATR charts. So give me any bank. I'll let you tell me what.
Citigroup was really the one that has had the worst reaction this morning, but it's not. It's not the strongest.
That's
of the
interesting.
banks.
So Citigroup, look at this massive run since the election.
Your chart didn't update on my end. Did it update on you guys?
Hunter, can you see my chart?
Yes.
Okay, now it did.
And now, yeah.
Okay. All right, maybe there's a little lag. Well, we'll go a little bit slower. So there's Citigroup, and then you can see up at the third ATR as it approaches earnings. And so is this what is it down? It's down 5% today. That's still holding the gap up from the beginning of the year. That's how much these stocks have run. It could be down 5%, but it's still above this consolidation from the beginning of the year.
And you can see that 11.9 gap up on that chart.
Yeah.
That was with the announcement of the efficacy of the Pfizer vaccine.
Yep.
That big gap up, and it just has ridden the +2 and the +3 ATR for a while. One pullback and then a gap up last week.
And then if we look at, say, the regional banks, so we'll just look at KRE to make it a little easier. This is not that bad of a, now they don't report in earnest till next week, but this is not a bad reaction. It's just that everything is kind of extended up here. And so if stimulus was, what's going to be announced? Or what's the impetus? You're having your earnings coming up, and it's got to be earnings. And if these stocks don't move higher with earnings, I'm not sure what happens after earnings season to stocks. Any thoughts on that, Don? Or
I just look at the reaction. I don't try to predict it. And you can't even look at the number, honestly. The number, you could get sold off on the number for the quarter if the following quarter is projected to be weak. So it's really the looking forward, whether somebody raises guidance on earnings or on sales. That's really what'll tell the tale. And if you raise guidance and get sold off, that's a big red flag.
what else you got? What other moves have taken place so far?
We talked about XOP, that's oil producers.
There you go. Okay, I don't know if it's up on your screen yet. It's up on mine. I don't know if, Hunter, you can see it.
We can.
Okay.
It's a little bit lagged, I think, maybe.
Yeah,
Okay.
there. So there you can see the big run over the past 2 weeks up to you went to the 3 ATR about, 5 weeks ago, pulled back to the mean,
Yep.
took off. Oil's given some back today. Semiconductors have been what's propped up the NASDAQ 100. If you bring up the chart of SOXX, this is the ETF that matches the SOX index. And very clearly that's been extremely strong and way stronger than the relative strength of the big tech stocks like Apple, Amazon, Microsoft, Netflix, Google, Facebook.
What else you got?
A lot of software, some of the software stocks had a good week. Also, the metals and fertilizers continue to be strong. And again, they're giving some back today. Bring up FCX.
Look at that consolidation towards the high. Going to report looks like 125, 126, 126 before the market opens.
Yeah, that's been extended for a while, but you can see the big tail on that from Monday. Same situation today. They got sold off hard at the open, but money flowed into it, and that's showing some extreme strength. Bring up the chart of X.
X.
Again, another stock that bottomed with the market, and then the 11.9, well, in this case 11.16, you can see the big gap up, banking on economic recovery. Gap down today, but it's forming a hammer, so it's well off the lows.
It'll be really interesting to see what happens with this market. The market is designed to take the money it's given you to take it back, and at some point it's going to take the money back. It just, Danny, we taught a class. Remember that group? We taught that technical analysis group. We taught that class too. Like
Yeah.
it's the market is just a mechanism to give you money, and then when you're not expecting it, take it back. And I wonder if we've entered into a period right now for a little bit of that. It'll be interesting to see what happens. Danny, I think you were going to say something.
Well, I was going to say, I started laughing because you said it's created to take the money, to set you up and then take the money from you. It's just like those casinos and gambling apps. So I want to be the owner of those stocks. I don't want to be the consumer of those stocks.
In my reading up weeks ago of like they opened up the gambling in Tennessee, and one of the sports books that opened up in Tennessee isn't as well known, and you have to have, it isn't as well funded, and the way that the sports books fund themselves quickly is they offer these low teaser rate parlays, and Hunter does the parlays. He's our parlay expert. And so even though it might be $5, $10, that enticement of it's only $5 or $10 multiplies, it compounds very quickly. And that's how the sports books build up their reserves very quickly to remain viable sports books. And you have to keep playing. You have to, the longer you play, there's more of a chance that you'll give it back. And someone would say, well, what's the difference with the market? It's having a sell discipline. It's like what, Don, quickly encapsulate what gets us out of stocks.
Breaking of key moving averages. Every 20% correction has started as a 5% correction. And we invest across 3 time frames: short-term, intermediate term, and long-term, using the 21-day exponential moving average as our short-term indicator of strength. When leading stocks and or the indexes are trending above the 21-day exponential moving average, we want to be as maximally invested as we can in leading stocks. Sometimes the indexes hold up fine and leading stocks start to sell off. That happened at the end of December, and we lightened up on some of them and rotated into some other industries. But as you break the 21, and then if you break the 50 intermediate term, you could be heading toward some type of a correction, especially breaking the 50-day. It's a very key technical level that a lot of algorithms and traders watch. And then you don't get into serious trouble unless you break the 200-day moving average. And at that point, we're either going to be fully hedged or mostly in cash.
Yep. And so,
Don,
look,
I was just impressed of your use of maximally.
Maximally. Is that a word? Maximus?
I was thinking about that.
Fully?
Don may have pulled a Tim Razor Snigler.
I may have.
Absolutely.
I think that actually may be a correct word, but used very, very infrequently. Don, Google that and let us know.
Get back to us on that. So, stock numbers and market levers. I wanted to.
It is.
Don, I'm sorry.
Maximally.
Of
relating to or consisting of a maximum, being the greatest or highest possible.
Used accurately then. Very nice.
Yeah, maximally.
Yeah. So stock numbers, market levers. Listen, I want to cover something here in a second with you, but how we handle markets and how we.
Before you move on to that, can I address something from the videos? I liked your class that you did this week, but why did you pick a mediocre rock band to describe the setup?
Oh my gosh, no, ELO is, there it is, the ELO setup, man. I love that song, Mr. Blue Sky. That's the best song ever. History of songs, man.
Well, sure, but I mean, isn't ELO really the Carson Wentz of rock bands?
Oh, not even close. ELO is in the Rock and Roll Hall of Fame. And
well, if you're going to pick a band, pick Kiss.
Don.
Obviously.
At least it wasn't Barry Manilow. At least it wasn't Barry.
I was expecting ELO to be an acronym for something. I'm like, okay, the E probably is earnings. Like, let's see what the L and the O are for. But no, it was just a mediocre rock band. And if you pick Kiss, you've got a band because ELO is basically Jeff Lynne and nothing else.
Yeah, it is Jeff Lynne.
Kiss, you've got all 4 members had their own characteristic. They all contributed to lead vocals. And, it's a great acronym, too. You've got K for a catalyst, because I know catalyst begins with a C, but not in Kiss. Everything
like
begins with a K.
Acronym. Sure.
Yes.
Yes.
You've got I, institutional support. You've got S, you need sales. You've got the other S is strength, as in relative strength. So, we'll just go with KISS, and also keep it simple, stupid. You don't want to get overly complex with investing. So that's really the acronym that I would recommend if we're trying to pick a band to summarize investing. Say again, Dan.
I like to keep it simple, stupid better than that first one where you kind of forced it out. But
it's not forced. The KISS coffin is spelled KOFFIN. So you can be buried in a KISS coffin.
Is there KISS coffee? There's got to be KISS coffee.
If there's not, I'm sure Gene's working on one.
The Beth Brew?
I think there is. I think there actually is.
So what I was going to say, stock nerds, look, however, it's not how we decide. It's whatever the markets decide to do. We update it in real time. And there's a question. Look, if you're, it'll sound self-serving coming out of my mouth, but I don't mean it to be. If you're if you've missed this move and you're considering a money manager, an asset manager, whether it's us or somebody else, I wish it was us. I mean, we hope if everybody who watched these videos came on board as a client, we'd be one of the largest asset managers in America. But that said, uh, that
Getting
said,
there, we're growing.
getting there. But whether it's us or yourself or somebody else, when you're the ELO setup does this, all of Don's videos do this, and Hunter will talk about it as well when he starts doing his videos. The question you have to ask yourself is, you know, like the biggest concern right now is, will I have enough money for retirement? And it might not seem like you're asking that question when the markets are at all-time highs, but that's what you're concerned about, especially folks who lived through the dot-com implosion, who were investing in 07, 08. You have that memory. And so as you get, you know, 45, 50, you're thinking, okay, what's going to happen to this money in 10, 15 years? And right now, a lot of people, they have dollar signs in their eyes, and it's going to compound and go up, triple when you see things that are happening in the market right now. The most important question you could ask any money manager, whether they work at Edward Jones, Raymond James, Fidelity, Schwabi, TD, it doesn't matter. The question to always ask is, what gets you out of markets? When would you sell? And if the answer is a dance around, or the answer is, well, why would I get out of markets? You need to turn and run, because what's going to happen is you're going to be shown probability charts. You're going to be shown spreadsheets, and nobody shows you anything that doesn't make them look good. That's why we don't have brochures. We don't have probability charts, because what were the probabilities in 1998, 1999 that from the year 2000 to 2010 would be labeled by the end of 2010 as the lost decade? What is the probability of that? And then, so what was the probability of someone, because there's somebody that's contemplating retirement in 1999, thinking that, oh my gosh, I've got the old E-Trade ad, I've got money coming out the wazoo. And then in succession, you had the dot-com implosion and then the horrific terrorist attacks. And that in itself was almost, you know, was a yeoman's task to recover from. And then you recover from it only to get walloped by 08. And so if someone ever asked any of the four of us, well, what are you going to do to grow my wealth? And I always say, well, how, you know, do you want to lose your wealth? And the answer is always no. Well, then the first thing we're going to do is protect your wealth. The first thing we're going to do is tell you what our sell discipline is, what gets us out of markets. And then we can talk about growth, but nobody wants to talk about selling with you. They want to fill your eyes with dollar signs. And then Danny is the one who teaches us all this, that by law, you've got to fill out a questionnaire, like a get to know you sheet. And on that get to know you sheet, it always, by law, is asked, what kind of investor are you? Are you conservative? Do you consider yourself a risk taker? And there's a couple of variations of that. And all that is to profile you. So if you're conservative, there's a really good chance that you're going to get put in a bond-heavy portfolio, which Danny alluded to earlier, is really dangerous right now. And if you're really conservative, you're like, I don't want to lose anything, you're going to get sold life insurance as an investment, which is illegal, but you're going to get sold life insurance, or you're going to get put in an annuity. And Danny, very quickly, why are life insurance as investments bad, and why are annuities bad? Just very quickly.
Well, life insurance is not supposed to be sold as an investment anyway. So they've got these permanent products where supposedly if you need life insurance anyway, and that's the main question, do you need it anyway? Then you can have kind of this cash account or side account that you can put extra monies in there, and it either grows at fixed interest rates, or if it's a variable, it can have mutual funds and what have you, but it's got a limited number of choices. It's almost always I mean, there are a few exceptions, but it's almost always better. You remember your grandfather, your priest, your rabbi, your pastor, your friend, your finance guy said, invest it by cheap term and invest the difference. You're almost always better coming out ahead doing it that way than doing a permanent life insurance. Annuities are just very clumsy. They're expensive and they're not tax efficient coming out, but they're very expensive. The wrapper is expensive. And by the way, folks, there's actually no load, no commission insurance and annuities that can be managed on kind of an ongoing basis by an advisor You never hear about those. You don't even hear about those. Why? Because the insurance agent wants to make a big commission and look for the next sale. He doesn't want to work and earn your trust little by little every day and continue to do it. So Tim is right. The first question you want to ask is, what is your sell discipline? And buy discipline, how do you know when to buy? Because timing is important. But number two, are you a fiduciary? Are you a fiduciary? If the guy's working at the firm with the name on the door, whether it's Fidelity, Schwab on the discount side, Morgan Stanley, Edward Jones, doesn't matter. There's a conflict of interest. It doesn't mean he can't do a bad job. It just means there's a conflict, and you've always got to be on guard for that, and you've got to watch for that. One last thing, Tim. You said the risk tolerance questionnaire and all that stuff. The bottom line is, everybody, when the market's going up, everybody wants in. When the market's going down, everybody's a wimp. So the people's risk tolerance actually fluctuates with what the markets are doing. So, or it's behavioral finance. But as far as risk tolerance, it's much more important how much risk is in the market, the sector, the stock itself, what the markets is doing, than what your personal risk tolerance is. If you've got a sell discipline, because if you've got a sell discipline like we do, you can get defensive when the market's getting hammered. So you don't have to get hammered. There's a way not to get hammered. And then when the market's good, you can participate. Are there times you'll miss out a little bit and the market will outperform? Sure. There's also times, you'll outperform the market by not giving back big chunks of the decline.
And last week on the video podcast, we actually covered some of the best ways to hedge, and what the difference is between buying a pullback, how to avoid a sell-off, and hedging. And so we'll get into that a little bit more as the market progresses here. But Hunter, what do you have, brother? What's your big research you want me to look at with you?
Well, I've got a little bit of everything. I got some stuff about video games, the resurgence of 3D printing, at least in relation to a couple of stock prices.
Muted yourself,
A little bit. What'd you say? Can y'all hear me?
I can hear you just fine.
I can hear you.
Okay.
I can hear you.
Alrighty. And then also a little bit of solar, and then one sports betting name that's also a combination with streaming. So first thing, will you just pull up ATVI, Activision, for me?
You got it, brother.
So, these stocks haven't been necessarily leaders in the market, at least going back to prior to COVID and even after COVID. However, they did have a really strong run where they showed a lot of relative strength over the last couple of months. And ATVI is actually green today when the market is down, and they're right on their 21. And the reason I want to mention this is video game spending hit a new record in December with Call of Duty Black Ops being one of the best sellers. They also have Warzone, which is a component of that. And I'm familiar with it because I've played it. But I mean, people spend money on this like people were spending money on Fortnite. So it's not just like a one time you buy the game. They spend money on it continuously, which maybe shows the changing character in the stock price. So the group as a whole had a really strong move. But as I was going through some of their peers like Take-Two and EA, Nintendo actually also looks okay. But ATVI seems to be holding up better than the other guys. And you can see Take-Two's down today. They actually broke the 21 yesterday, I believe. So just to show you a leader in a space that had a strong move, Activision has acted pretty well. And the consolidation actually looks really healthy right on the 21.
It's a nice looking chart of EA as well, like you mentioned. Okay, what else you got, brother?
Next thing, go ahead and pull up DDD.
Oh, yes.
So actually not long ago, we talked about how this thing was absolutely garbage, and it has been. And you can argue this is a short squeeze here, but I'm going to tell you what happened and what drove this massive 104% up day a few days ago. So it was announced that they sold their non-core software business with the intent to be, focus on their core business. And as a byproduct of that, they use some of that proceeds. They're going to use some of the proceeds to pay off debt. Also, they reported strong preliminary Q4 results. I think revenue 170 to 176 million versus 140 million estimate. And I believe there's been mention of Kathy Wood including 3D companies in the space and exploration ETF. I'm not 100% sure on that, but the point is this thing had a massive run, and I want to show you another name in the group that's actually, I guess you would, as Don likes to say, new merchandise, DM, Desktop Metals. And I'm going to tell you a little bit about what they do here. Let me pull up my research spreadsheet. So DM, and this is directly from their website, exists to make metal and carbon fiber 3D printing accessible to all engineers, designers, and manufacturers. Their goal is to reinvent the engineering and manufacturing process from prototyping to mass production. And kind of their big quote or claim is to reinvent the way engineering teams produce metal and composite parts. And so you can see this chart actually looks healthy. I mean, it's actually behaved really well. As opposed to, how DM behaved or DDD behaved for a long time. So just two companies in space that was garbage for a long, long time, showing some resurgence. Time will tell if it's actually, there's merit to it and it will be sustainable. But I just wanted to point this out because it's, something kind of crazy that's happened just in the last couple of weeks. The next,
That's why you got to be flexible. Remember, 3D printing was $100 4 or 5 years ago, and everybody said it was going to $1,000.
yeah, and maybe this is a pivot. Maybe things, have changed and the perception's changed, and institutional ownership will follow. Like we said, you just got to kind of watch and see how it plays out. Will you pull up TAN, please? TAN, Tim? Solar ETF. And I actually did not plan on talking about this today, but due to the price action today, I made the decision to talk about it. A lot of solar names pulling back today. For the most part, the leaders in that group are still above their 21-day exponential moving average. But TAN pretty much touched the 21 earlier this morning. And so, maybe that's a good entry. It had gotten really extended for a while. I think got up to around like 120, 125 range. And I guess you can make the argument that the stimulus bill that Biden proposed didn't have enough in there about solar, alternative energy. But I want to present this just because maybe it's a buying opportunity when you haven't had one in a while because of the run that solar and alternative energy has gone on. And the TAN ETF is a nice way to play these. Usually it's less volatile than their peers, but as you can see today, I mean, it's down almost 6%. But Sun Power is down about 10%. Sun Run's down about 5%. So it kind of varies. But I wanted to show this because it might be a viable opportunity. The last thing I want to show you here, can you pull up Fubo, please? Now Fubo, it's right on its 21. This thing is unbelievably volatile. Had a big gap up on the announcement that they are going to acquire Victory, which is a startup sports betting company with their own sports book. And this thing, once again, it's one of those things where time will tell if this is going to be legit. But it's a combination of sports betting and streaming, and there's not another company that necessarily is aiming to do that. So it's something that's new. Maybe it'll work, maybe it will not. But from what I've read, their focus is their idea is that if we can, integrate sports betting with this, maybe it'll increase the funnel of customers to our streaming service. So I just want, it's not a DraftKings, it's not a Penn. Obviously, they had a massive run and a really ugly sell-off, but it is something unique. I believe, Don, can you verify, did they raise their guidance moving forward?
No, it was, as far as I know, it was just the purchase of the Victory on Tuesday that popped it off the moving average.
Okay. Well, just something to look at as a different way to play the sports betting space. It's kind of a combination of a Roku and a DraftKings kind of thing. And I believe when they first started, their focus was soccer. They're just kind of, now it's sports first, football, basketball, whatever. But something to keep an eye on, something new, something innovative. But that's it for me, Tim.
Okay, awesome. All right, Danny, I'll tell you what, take us out, Danny, with the normal close. What we'll do is I'll ask Don to give a quick update to what he's looking at in 21 over 21, and then I will, I've got one last thing for stock nerds.
Folks, listen, if you like what you heard, please tell a friend, tell a neighbor, just send them to revereasset.com. They can just click on the subscribe button and put their email in. We won't spam them. We won't bother them in any way. It's up to them to reach out if they want our help. But this podcast will be delivered to their inbox, normally on Saturday morning, and our daily market insight, our short market video every night that the market's open will go in their inbox in the late afternoon, early evening, whenever that's done. You can also sign up for webinars, which Don occasionally does every couple months, time permitting, a lunch and learn where he'll go over a topic or go over the markets in general. It's an hour long, 12 Eastern time on a Wednesday normally. And you can do a Q&A at the end. If you've got any questions, you can email us at dan@revereasset.com, don@revereasset.com, tim@revereasset, or Hunter at Revere Asset, and pretty soon Alex at Revere Asset. He's going to be starting next week. It's a new addition. And or you could always call us old school at 855 Real Wealth.
All right, Don, what you got, man?
Really, a lot of the pullback in the leaders today is just giving some back from conditions where they were well extended from the 21. Three that are falling off the 21 over 21 list, though, are ticker FTCH, Farfetch.
Mm-hmm.
See it rolling over, breaking the 21. AMD, which semiconductors have been strong, but AMD and NVIDIA, I talked about how we sold NVIDIA earlier in the podcast. Those two have been serious laggards lately. So you can see AMD sitting on the 50, but clearly broke the 21 with a failed breakout there from earlier in the week. And also Lulu, which we also sold, breaking the 21. Not only 21, also the 50. So those three will, at a minimum, be replaced in the 21 over 21 list when I update it over the weekend.
Awesome, awesome. All right, stock nerds and market lovers. I've got the video this Friday. I'm going to do the 5 at 5. We'll update all that, what's come off of it, anything we added this week, we'll talk about. And then let's look at gold here real quick. Not a safe haven as you're looking at this, as gold had that one good day to start the year, and then this big push lower, and now it looks like it's forming this bearish type flag around the 200 day, and typically those resolve themselves to the downside, and you can see like right here with a little bit of a flag, it kind of tried to go and then it just sold off right there. So be very careful in the gold space. But I've got the 5 at 5 with you this week. But look, if you got any questions on Hunter's research, Don's 21 over 21, just email, get a hold of them. We're very excited. We're one of the few firms that's accessible and as transparent as we are. All right, Danny, take us home.
Folks, listen, have a happy and safe 3-day weekend, and we'll talk to you next week on Your Money.